This is a continuation of the Danielcode Learn to Trade or DC Trading Manual, and this is a continuation of part 1. You'll see that already in previous parts of this video. We've got up to chart 16. We're now moving on to chart 17, which shows the same group of numbers that I put on in an earlier chart, which I think was chart number 9, and what I've done here is I've just taken out the arrows that pointed to non-trading recognition. That is, if it's going down we need a low on the Danielcode number, or in very rare cases a close. So we're now left, as you'll see, with 3, 4, 5 arrows, and they're numbered 1, 3, 4, 5 and 6. Now all of those gave us recognition of a Danielcode number. The question which we need to answer for ourselves now is which one. The most common comment that I get from members who are trading or trying to trade the Danielcode is, oh, you've got too many numbers. Well, it's not a question of how many numbers I've got, it's a question of how many numbers the market creates. In a longer, slower chart, weekly and monthly chart, there are fewer market structures, so therefore there are fewer Danielcode numbers. Every market structure creates a new group of DC numbers. So when you move from a weekly chart to a daily chart, you have many more turns, many more highs and lows, and therefore you have more DC Danielcode sequence numbers. When you move from a daily chart down to a 40-minute chart, 60-minute chart, you've got many more turns, many more highs and lows, and each of those turns, each of those market structures creates a new sequence of Danielcode numbers. Now, what we try to do is to reduce them to a minimum that the human brain can cope with. We know that if we computerize this whole process, we can get every turn because the computers can read unlimited price levels. We can't, so I've had to reduce this and simplify this to a format that the average intelligent, hard-working trader is able to execute the trade strategy. So let's have a look here and go through these in detail. At arrow number 1, you'll see we had an intraday reversal. It was also an outside bar, that's why it's grey. If you look down to the stochastic indicators, you'll see that both of them were in an oversold position, the fast stochastic and the slow stochastic. Now, this is the most basic type of reversal, but we got an intraday reversal. And we got momentum off the turn and a big gap up the next day. When we go and look at the bars on where the arrows are on 3 and 4, you can see that the stochastics themselves are oversold, but we didn't get a turn. The final part of the Danielcode trading puzzle is, once we get a setup and everything complies with our trading rules, we then need price to confirm to us that a turn is being affected. So we may think that we've got the setups, but we don't take any action until price pulls us into the trade. So if we look at that, we'll see that where arrow 3 is, the next day it didn't trade above that. For arrow 4, the next day it didn't trade above it. For arrow 5, we get a lovely reversal right on the Danielcode number, and the next day it gaps up and takes out the high. If we're trading off a daily chart, that's our signal to get in. Now you may think you've left a lot of the trade on the table, but I'm going to deal with that and show you how to handle that in a few moments. But off the daily chart, where would you get the confirmation that a trade turn on the Danielcode has happened? When the high of the setup bar is taken out. And in fact, just to make things perfect for us, that bar, the next bar after the one arrow at 5, opened about 2 ticks above the previous day's high. That's been that arrow 5, happens to have been the low in the S&P so far. And at the open we had a valid signal. We bought that bar and we exited at the first profitable opening, or I did it anyway, and it was worth 107 big points. about $22,000 a contract. We see then that we have the same procedure, and we go down to level 6. Well, let's just move on, and we'll now go to chart 18. It's exactly the same chart. Nothing's changed. The arrows are still there. I'm sorry that the numbers are cut off, but you can work out which ones they are. But we've now changed this chart from a daily chart to a 240-minute chart. In fact, in the S&P, you need to get down to a shorter time period than that. The best bars to use for the S&P are, in fact, 151-minute bars. Same for the Dow Jones. You can use either 148 or 151. Basically, they're the numbers at which those markets vibrate, and that breaks them up neatly into 3 roughly equal sections during the day. So now on chart 18, it's exactly the same chart, but look what we can see. All of a sudden, in the previous chart, we saw the turns at bars at arrows numbers 1 and 5, but we didn't have the stochastic set up to give us the turn at arrow 6, and it was an important turn. If we run down the time frame, we reduce that daily chart now to a 240-minute chart, we can see that indeed the fast stochastic was in an oversold position for that bar. And you can just see the top of the arrow, even though the 6 is obliterated. It's the bar that bottoms at the Danielcode number at 864. You'll see this same phenomenon, that price level was ignored on the way down. It went straight through it, but look, let's come down again, and it's tested that 864. The fast stochastic is in an oversold position. That's going to give us an entry at the high of that bar. We want price action to confirm that we're indeed getting a turn. So let's now just review that, and what we're going to do is put it all together. We're still on the same S&P chart. The only difference is I've taken off the various Daniel numbers that were not operative, and I've added the red retracements, and they're the retracements from the low up to the gap up high 2 bars to the right of the number 1 arrow. They're the normal Danielcode retracements that go on all these charts, and we can now put it together and see what this market did. First of all, we've got our buy signal at arrow number 1. Same deal. We've got market recognition of the Daniel number in that bar. We've got our slow and our fast stochastics oversold. We're now looking at a 240-minute chart, and we look for price to pull us into the trade at the high of that setup bar, and it does. We get 1 bar up and then a big gap up into the next day. That's our trade. The market then turns around and starts coming down. It gives several signals, continuation signals, on the way down, and then you'll see at point number 4, arrow 4, it stops its bar right at our 909.80 price level. By this stage, both the fast and the slow stochastic, and you'll see they're exactly the same stochastics, nothing's changed except the time frame. On our 240-minute chart, we've got market recognition of a Danielcode price level. We've got the slow stochastic oversold, the fast stochastic oversold. What are we looking for now? We're looking for price to pull us into the trade. We want to actually see the turn, because we know that markets will often recognize the Daniel numbers by a vibration, but they don't actually give us a turn. So we're concerned with the turn. So where are we going to buy this market? We're going to buy it at the top of the bar with the number arrow 4 pointing to it, and it doesn't get filled. The market then moves down and it slips through 1 Danielcode level at 864, and it puts in its low at the next Danielcode number, which is on the other sequence on the right hand side at 838. For good measure, it turns around and closes right at 864. So it's showing us there it knows both these sequences. It bottomed at one sequence, the right hand sequence, and it closed at the left hand sequence. These numbers are like magnets for markets. They keep going to them again and again and again.